This video, I want to talk about the risk and reward of investing in developed markets. The risk and rewards of investing in developed markets. We have developed markets, we have underdeveloped markets, and we have emerging markets, we have developing markets. And so let's start with the rewards. Number one here is stability and predictability. That's a very important reward of investing in the developed economy. The developed markets, generally provides a stable economic and political environment. They are well-regulated economies, and financial systems offers a safer investment landscape, with less susceptibility to extreme volatility, like what is obtainable in emerging markets, making them attractive for conservative investors. They are more stable, they are predictable, they are not like emerging markets that are characterized by instability, unpredictability, and sometimes problems here and there. Number two is lower volatility. Lower volatility. And you discover that these markets typically experience less drastic fluctuations. They're not that volatile compared to emerging markets. This lower volatility is appealing. It's appealing for investors seeking less risky, investments and more predictable returns. You want predictability in your returns, and you want to have you want less risk in your investments. Then of course that is what characterizes developed markets. Number three is mature financial systems. Mature financial systems. A developed market boost well-established financial infrastructures with strong regulatory oversight, making them more reliable, for investors. They have very strong financial system. Unlike ours, that we have been coming in from time to time to raise more capital to boost our bank capital base. No, their own is highly stable. This system facilitates efficient markets, capital markets, offering high liquidity and a broad range of investment opportunities. Number four is economic growth. Economic growth. Though growth in developed markets is often slower, it is still steady. Compared to emerging markets, growth in developed economies, developed markets are slower than what is obtainable in an emerging market, but they are more predictable. Actually, they are more predictable. And so, the high standard of living and strong consumer demands across various sectors like technology, like healthcare, like consumer goods, like financials, actually provides long-term investment opportunities. Discover that growth in the individual sectors in the markets provides, opportunities for diversification and for a better long-term results. Number five is global economic influence. Global economic influence. So developed markets, particularly those in the US, Europe, and Japan, they play a pivotal role, an important role, a crucial role in the global economy. The stock markets in these regions are among the largest, and the most active, the most liquid, and are making them essential for diversifying investments, for diversifying your investment portfolio on a global scale. You want to diversify on a global scale, you may choose to invest in the US. You can do it easily from Nigeria. Just download the Afrinvest Optimus app. You are good to go. You could become a global investor. You can download even the Chaka. the Chaka app, and invest globally, particularly in the US. Please subscribe to this channel and like this video. If you've not done that, it will motivate me a lot to keep on bringing quality contents like this to you. So we've considered the reward actually of investing in developed markets. That's stability, low volatility, mature financial markets, economic growth, as well as global economic influence. We want to look at the risk of investing in developed markets. Number one is lower growth potential. And so since developed markets are already highly industrialized, their growth rates are often slower compared to emerging markets. So investors may not see the same high returns as those found in faster growing economies. The rate of growth is not as much as what is obtainable in emerging economies, in underdeveloped markets. Number two is economic cycles and recession risk. Economic cycles and recession risk. So although most stable developed markets are still susceptible to recessions, which can lead to decline in stock prices and economic activities, they are still subjected to the normal volatility that's inherent parts of a typical stock market. So they're not all that immune to it, though on a lower degree compared to emerging markets. So global economic slowdown can have a significant impact, on these economies. Number three is high valuation. Stocks in developed markets are often at higher valuation relative to their growth potentials, which can lead to reduced future returns. Generally, the markets there are more efficient, and that's why the stocks there are adequately valued, if not highly valued, they're adequately valued. So you hardly come across opportunity for undervaluation. So the market is very efficient, and not only that, this can make it challenging to find undervalued stocks, particularly when the market is overinflated. It's difficult to come across undervaluation, to come across cheap stocks, because the market there is relatively efficient. Number four is regulatory risk. So despite their strong regulation, the regulatory framework there is very strong. Businesses in developed markets face ongoing changes in government policies and regulations, including tax laws, environmental rules, and trade policies. Not only that, these shifts can impact profitability and investment returns. So they're highly regulated, okay, and they still face government policies here and there. Just like Trump was sworn in, and he brought in policies that affected the market some, particularly the trade wars between the US and China. That's an event that will affect the market negatively. You see. And so number five is market saturation. And so in many developed markets, industries can become saturated, meaning companies may struggle to find new opportunities for expansion. So this can slow earning growth, especially in sectors like retail and manufacturing, where demand might be at its peak. And so the market is saturated, kind of, there's less room for expansion compared to developing economy. So in conclusion, developed markets offer stability, lower risk, and a reliable returns, making them attractive for conservative investors or those seeking, stable long-term growth. They typically provide slower growth and face challenges such as high valuation and regulatory changes, which may affect, future investment returns. It may affect future investment returns. And so investors should carefully consider these factors when deciding whether to allocate capital to developed markets or not. So consider this risk and also consider these rewards before you allocate your capital to uh, to invest in developed economy like the US, like Europe, like Japan, like China, and as the case may be.